People are curious what led to infamous 1929 stock market crash in the US. Gaining valuable insights into reasons behind it surely will empower you for future investments. Hi, my name is Sunny, and a quick like share alongside smashing that like button will be highly appreciated. Stock market crash that happened in 1929 left an indelible mark on the global economy. Like all good things, asset bubble that was building at that time was ready to burst. Now when this historic meltdown finally began, momentum was so huge that every part of the economy was hit. It took a long time both for people and businesses to recover from this financial meltdown. This fateful event has an enduring effect on the world economy, and many new regulations were put in place just to avoid this happening ever again. Financial crisis of 2008 was the closest to what happened during 1929 meltdown in the US economy. One of the leading reasons for 1929 market crash was excessive speculation. Overvaluation created an unsustainable asset bubble. As more people join speculative buying, lack of regulations become even more glaring. When markets start to go down, margin trading leads to margin calls, creating an economic meltdown. But the key thing remains absence of proper checks and balances as well as lack of regulatory oversight. All this led to fraudulent trading practices, where additional economic pressure led to what unfolded in late October 1929. Consequently, this not only affected US financial system but broader US economy, which eventually led to Great Depression. Two catastrophic events, Black Thursday and Black Tuesday, marked climax of this financial disaster. Black Thursday, October 24, 1929, started with wave of selling on New York Stock Exchange. Panic selling overwhelmed the markets, taking Dow Jones down by 11%. Evidently, lack of buyers accelerated devaluation of stocks as everybody wanted to deleverage. Black Tuesday, October 29, 1929, was when intensity of sell-off was unprecedented. This carnage plummeted Dow Jones by another 12%, that too after Black Thursday. There was glut of selling orders as panicking investors were offloading their stocks and there were no buyers. Massive fortunes were wiped out as stock market effectively collapsed. As investor confidence eroded, stock prices declined abruptly during 1929 US market crash. Individuals and institutions faced enormous losses that brought financial instability and loss of confidence. All this led to withdrawal of funds from banks, which triggered bank failures across the country. People lost their savings in failed banks, while businesses lost access to capital. This widespread credit contraction further complicated problems, which led to slowdown in US economic activity. As business faced reduction in demand and credit crunch, layoffs led to widespread unemployment. Consequently, with this sudden deceleration in velocity of money, millions of Americans were facing financial uncertainty, widely known as Great Depression. The overall impact was staggering, but it's hard to quantify losses incurred during US stock market crash of 1929. By 1932, Dow Jones Industrial Average fell by about 90% from its peak. Millions lost their life savings. Worst hit were who bought on margins. Widespread bank runs led to bank failures where depositors lost their life savings. As a result, credit dried quickly, leading to enormous bank failures. Alarmingly, by 1933, US unemployment reached about 25%. We saw immense wealth contraction as all asset classes collapsed in valuation. This financial crisis spread beyond the US, affecting the global economy, which took long time to recover. No doubt, 1929 stock market crash caused a widespread financial devastation, but in this mess, there were some winners too. Small group of smart investors did profit by short selling stocks. Most famous one was Jesse Livermore. Short selling involves borrowing a stock, usually from a broker, sell them in the market expecting the price to fall, buy when it falls, and finally pocket the difference as a profit. It did compound the situation negatively, which led to financial meltdown and a market crash. Proportionately, winners were very less when you compare the widespread destruction it caused in people's lives financially. Hope you get my point. Indeed, there are many similarities between economic conditions during 1920s and today. Like back then, asset valuations are crazy these days. I believe PE ratio for certain companies or specific sectors are too inflated. Levels of debt and even overall money supply make me think how sound financially fundamental asset prices are today. Unsustainable levels of debt could pose risks to our financial system, especially when rates are going up. But on the other hand, I believe in capitalism where inefficient ones are shut down while new and efficient ones thrive. Recovery from Great Depression proves the resilience of the US economy and capitalism, so I am cautiously optimistic. As a disclaimer, I'm not a financial advisor. Please consult one before investing based on your personal financial situation, and don't forget to do your own due diligence. If you like the content that I make, please help me and my channel by liking, sharing, and subscribing to it. Thanks for watching and see you in the next one.